Vitec Software, fallen from grace. Vitec is a serial acquirer from Sweden, trading at a market cap of around 12 billion Swedish kroner at a share price of 290 SEK. Vitec operates in the software market, specifically as a VMS or vertical market software provider. They provide very important software services to niche industries, where the software typically is highly integrated in a business operation. This gives favorable economics, meaning switching costs, pricing power, and stability of cash flows. Vitec has experienced an incredible stock drawdown in the last few years. They have fallen more than 50% from the top and trades at the lowest stock price in 5 years. The reason for the fall is an initially very high valuation, as well as an increased competition in the M&A space they operate in. Also, they have seen stagnating growth in the latest quarters. Questions are asked, for example, about the potential AI risk, and the multiple has gone down. However, this is without doubt a very high quality company. They enjoy a high degree of recurring revenue, has a long runway for growth in Europe, and has delivered extreme shareholder returns since going public. The question remains, though, whether the stock price is attractive at these levels. This depends on your belief in the return on incremental invested capital, as well as in the future runway for growth with increased competition and a looming AI risk. I don't think I need to go deep into the strength of the software as a service business model. Many players in this space are aware of the benefits of vertically integrated software companies, and notable players like Constellation and Topicus are quite famous throughout the world. This doesn't mean that one can pay any multiple for these high-quality businesses, however. One of my problems with this sector is that many investors treat all of the players the same. You even have entire funds that own a part of nearly every player in the space, driving up the multiples. And higher multiples simply becomes a drag on future returns, as we have seen in the last months, when multiples for everyone in the sector has gone down. This leaves plenty of opportunities for fundamental investors, as all of these companies are not the same. You cannot do a peer valuation to state whether a company is over or undervalued. It all depends on the cash flows of today and the expected cash flows of the future. Keep in mind that if a serial acquirer has a 20% returns on capital and retains all earnings, then earnings will grow 20%. If the multiple stays the same, then the annual return is 20%. Sounds simple. The problem with many serial acquirers, and especially Nordic ones, is that they don't always retain all earnings. This is a problem with Vitec Software as well. Furthermore, there is a fair share of dilution, which is also a major drag on performance. The depressing thing is that most serial acquirers both pay a dividend as well as diluting existing shareholders. This is a major part in why Constellation Software is generally seen as the best company for investors in this space. Instead of boring you with lots of facts about last quarter's growth, meaningless PE multiples, EBIT margins, cash conversion, share of recurring revenues, etc., then I will try to focus on the few factors that I think truly matter for the future of the company and the stock. First of all, it's important that Vitec retains as much capital as possible if they can get a good enough return. Their payout ratio has been between 20 and 40% in the last 10 years, and in the latest years it's been quite stable, around 25%. It's important that this doesn't increase a lot in the future. This would indicate higher competition within M&A and less returns for the stock. It signals a shorter runway and should correspond to a declining multiple. Secondly, it's important that Vitec doesn't retain capital if this means that the incremental returns will be lower. I don't want to see them spend more money acquiring companies at higher multiples or see them lowering their hurdle rates. Also, I don't want them to start going after businesses that they don't understand as well as the ones within VMS. Also, I will be wary of a higher number of large acquisitions. This is okay to a degree, but one must proceed with caution. Moving on, I need to see strong organic growth from their existing businesses. Vitec pays a fairly high multiple due to the quality of their businesses. This means that organic growth in the high single-digit range should be both achievable and expected. If you look at the last 12 months free cash flows, which I define as cash from operations minus maintenance capex, then they trade at a free cash flow yield of about 5%. I include all investments in intangibles as CapEx, as these are cash investments with questionable returns for shareholders. In the past, Vitec has grown free cash flows around 20% per annum, which has been very impressive. Now, what are my expectations for future returns? I believe in lower future growth, both organically and acquired growth. Organic growth has stalled as of late, creeping towards mid-single digits. This is okay in general, but not for the multiples that Vitec tends to pay. This shows in the cash returns on invested capital, as well as the accounting returns on invested capital. Furthermore, I believe returns on incremental capital will be around 12%. Competition is fierce, they enter into new regions where some acquisitions are deemed to fail. With 12% returns on incremental capital and a 75% retained capital base, annual growth will be 9%. Add to this organic growth around 6%, and we get an annual shareholder return of 15%. In addition, we get an annual dividend of 1.25% because they only retain 75% of earnings. My expected total shareholder return thus becomes more than 16%. Sounds good, doesn't it? There is a catch, however. Vitec has a history of diluting shareholders. This has been okay due to the performance of the company and the stock. However, it's a drag on shareholders and must be accounted for when valuing the company. Annual dilution has been about 3% per year. This must be deducted from the return. Therefore, we end up with annual returns of around 13%. It's important to keep in mind that when I'm talking about growth rates, I'm talking about the long-term growth rate. Next year, next 2 years is very hard to forecast. Over the long run though, a 13% return is to be expected with my estimations. 13% is a decent return. However, it doesn't beat my hurdle rate at least 15%. Simply, the expected growth and the incremental returns on capital isn't high enough. The stock might beat the market that tends to deliver 10% per annum. Still, its shareholder yield is not enough for me to own the stock. Vitec is a fairly large player in this space. With a larger capital base, it's hard to grow fast and still keep the M&A pace at the same rate as before. Thus, multiples should go down. Contrary to what many believe, which is that larger players should earn a higher multiple due to safety or stability, I fundamentally disagree with such a take. Expected returns are lower, therefore the multiple must go down. Some might use Constellation Software as a contrary example, but keep in mind, Constellation is the exception to the rule. To keep the incremental returns that they have, as well as retaining so much cash and not diluting shareholders, is a very rare thing. Therefore, in the search for serial acquirers, you either need to look at smaller players with larger runways or at the absolute best in the business. To me, Vitec doesn't fall into either category, despite being a decent investment at this price. To sum up, I believe Vitec after years of overvaluation finally trades at a fair multiple. I'm interested in future returns from this point and believe shareholder returns will be above 13% per annum, if one holds for the long term. This is a good return, but not good enough for my hurdle rate. It might beat the market, but not enough for me. Whether one wants to hold the stock depends, as always, on your alternative cost. I'm ending with a public service announcement to all investors in serial acquirers. The recent drawdown in serial acquirers is long awaited. Many investors have simply bought a basket of these with little notion for the price that they pay. Hopefully, gone are the days where one can simply assume a higher terminal value to these stocks in order to justify an increase in valuation. One cannot put all of these companies in a basket and look at peer valuations. If this was enough to beat the market, then any machine or AI could do the job. We must be better than this. This is not financial advice. Thanks for listening.